Our ESOP costs have increased this quarter due to one-time cost on account of accelerated vesting on achievement of a certain milestone. Hence, it could be approximately 30 basis points higher than what we had envisaged. However, we expect this to be lower next year. With that, I will hand over the call back to Sudhir for his comments on the outlook.
Thanks very much, Ajay. As I shared earlier, at the end of the first 6 months of the current fiscal year, we have registered a revenue growth of 16.2% in CC terms, 18.7% in Indian rupee terms, and 13.2% in US dollar terms. We believe that sustained growth is a function of both signing large deals and equally importantly ensuring that existing business is retained. Over the last 6 years, the order executable that we announce every quarter, and we have this quarter as well, has correlated very strongly with the actual revenue and growth that we have actually seen in subsequent quarters. This has happened because not only has the large deal median size and velocity gone up, but also because our repeat client business at 93%, our ability to retain that business is best in class for a firm our size. This ability to sign large contracts and also at the same time sustain existing book of business gives us comfort that in fiscal year 24 and in the years beyond, we shall deliver sustained and robust growth. Based on our performance to date, we reiterate our annual revenue growth guidance of 13 to 16% in CC terms for fiscal year 24 and the guidance of adjusted EBITDA margins being similar to FY23 in FY24 holds as well. With that, ladies, gentlemen, I conclude my prepared remarks, and my team and I look forward to hearing your comments and to addressing your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question on the audio bridge may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Participants connected on video link, please click on the raise hand icon available on the toolbar, or you may click on the Q&A icon to raise hand. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Abhishek Pathak from HSBC. Please go ahead, sir.
Hi, morning. Thank you for the opportunity. Sudhir, my first question was around deal activity. Most large players have reported healthy...
Pathak, we are unable to hear you.
Hi, can you hear me now? Hello? Hello? Hello?
Yes, sir. Please go ahead with your question.
Hello, can you hear me now? Hello?
Yes, sir.
Hi, am I audible now?
You are
yes,
loud and
please go ahead with your question.
Yeah. Sudhir, my question was around deal activity. Most large peers have reported healthy multi-billion-dollar deal wins, but they've largely been around cost takeout, and they've been saying that the appetite for smaller deals and the deal velocity has become quite slow. Now, despite that, Coforge and even some peers of similar size have continued to report healthy TCV numbers. So how do we reconcile this? And for Coforge specifically, what offerings are clients willing to spend on in the current backdrop, which they are not willing to sort of pause or stop? And assuming this macro uncertainty persists, what is the nature of deal conversations you expect to have in FY25? Would they be materially different to what we are seeing right now? And how do we think about the nature of demand in FY25? Thank you.
Thank you, Abhishek. Thanks for the question. I can say straight off the bat that we do not relate to what you talked about as commentary that you've seen from some of the larger peers. We continue to see a deal velocity that continues to be very robust. We continue to see median deal size climb up, and when we look at the funnel even going forward, we feel very confident around the fact that the width and the probability of closure around large deals for us specifically stays very strong. So I mean, that's how I would characterize everything that we're seeing right now. We continue to see, if I were to actually parse out where we see large deals in the offer going forward as well, we continue to see digital transformation as a theme, not as a theme that has not really played out 100% or as a theme that has petered out despite the cost constraints that are there. Product innovation, legacy modernization, cloud migration continues to hold, and deals continue to come in to organizations that are resilient and adaptable. We continue to see a very significant focus from organizations across sizes and client enterprise organizations to very seriously consider challenger organizations like Coforge, which have crossed the $1 billion threshold, are by no metric small, and are active, strong, domain-focused and tech-focused like challenger organizations. We continue to see opportunities in GenAI and advanced analytics. So if I were to just pull this all together, productization, legacy modernization, product innovation, cloud migration, the ability to look at challenger organizations as organizations that have both the capability and the customer centricity, differentiated customer centricity and hunger to satisfy enterprise client demand is what is causing us to see the number of deals that we are seeing and, more importantly, converting them at scale.
Thank you.
Thank you.
Thank you. Our next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. So the first question, any recent conversation with the client gives you any change in view in demand outlook, where some of your other peers globally like Globant has been talking a recovery in the second half of the calendar year. Are you expecting any green shoots getting emerged?
Sandeep, in BFS we see green shoots, but we're trying to balance them against the geopolitical uncertainty that prevails. Insurance within the P&C space, we do see productization, product vendors like Duckweed, Bondpro, even Guidewire that John talked about during the call, as spaces where demand is seeing a clear uptick. Within the travel space, we're looking at productization, customer experience, and security as potential areas where we see emerging green shoots. Those are the sub-segment-wise views. Overall, on the macro front, I do want to reiterate, continues to be challenged, and demand does continue to be stressed.
Okay, fair enough. And last quarter, you said to achieve the midpoint of the growth guidance, we have to grow at 2.5% compounded Q on Q from 2Q to 4Q. This quarter is tad lower despite the great deal wins of the first quarter. So do you expect pickup in the growth in the second half? Because some of your peers has been also calling out higher than normal furloughs. So how do you see second half, and when do you expect the first quarter and second quarter deal wins, first quarter particularly, which was robust, to start converting into revenues?
See, unlike a lot of our peers, our deal wins have converted into revenue. So we not want. I think it would be very unfair to start characterizing our performance where we've grown 16.2% at the end of the first half and trying to conflate that with what you're hearing from some of our other peers. 16.2% growth in the first half of a year like this, with the kind of challenges that the industry has, even though we say it ourselves, is exceptional growth. So we don't really want to go back and try to take what we've already done, conflate that and contrast that with what the other peers have done. As far as we are concerned, every time we've called out large deals, we've also shown revenue growth post that. Look at the last 4 quarters of results, look at the first 6 months of results. We believe large deals have to continue to translate into revenue growth for us. Going forward, if we grow to hit the lower end of our guidance, all we need to do is grow 1.6% sequentially for 2 more quarters. To get to the higher end, we have to sustain the revenue growth that we've been seeing. We're already at more than 16% growth at the end of the first half. The macros are stressed. We believe that 13 to 16 will hold under almost every situation. And that's why we're going with the given range that we gave 6 months back and the year started.
Okay, fair enough. And last question in terms of margins, to achieve the adjusted EBITDA margin being at flat, the ask rate is still at 135, 140 bits Q-on-Q improvement in the next 2 quarters. So what levers which will help us to pull out such a big margin improvement quarter after quarter in the second half? And is it fair to assume the ESOP cost on a full year basis would be close to 1 to 1.1% versus 0.7% last year?
I'll let Ajay take the second question. As far as the first question is concerned, Sandeep, we're not planning to do anything this year, which is very different from what we've done in the last 3 years. Second half, there is a significant growth. Q3 to Q2, sequentially, we will see a very significant growth. We've already seen a 160 bits sequential growth. We expect the growth again to be very significant, around 100 bits or higher, Q3 over Q2. So there's nothing this year by way of a new lever that we plan to flex in order to get to the guidance that we've given. Trajectory will continue. The one point that I do want to add is last year at around this time when the firm was heading into the second half, we were looking at hedge losses. This year, given the currency movements, we are looking at hedge gains starting Q3 on. So that's why we feel confident, as I said at the outset, of getting back around the same adjusted EBITDA margin levels as last year. Ajay, over to you for the ESOP question.
Thank you, Subir. Sandeep, as I had mentioned in my opening remarks, the cost would be approximately 30 basis points than we have envisaged. You are right, it will be around in the range of 1 to 1.1% for the full year for the financial year 24.
Okay, thanks and all the best. I will come in the follow-up.
Thank you.
Thank you. Our next question is from the line of Manik Taneja from Axis Capital. Please go ahead, sir.
Hi, thank you for the opportunity. I had a question with regards to our offshore revenue mix, which has seen a significant increase post-COVID, and we continue to step up the pedal over there. How should we be thinking about this metric going forward? That's question number one. And the second question was with regards to the outlook on the travel and transportation vertical. We've had some commentary from global companies in terms of some cost pressures or demand cooling off. How do you see this translating to business outlook for us from a 12 to 18 month standpoint?
Manik, let me take the questions in order. The first question was around offshore revenue. When we hit 48% this question was popping up, and we tried to be very conservative and said that we don't expect it to climb materially, but it continues to climb. Going forward, we expect the climb to be far more gradual, but we still believe, given what's happened over the last 4 quarters, the number will continue to climb, but albeit climb a little far more slowly than it has over the last 8 to 12 quarters. As far as travel and transportation is concerned, the commentary that you talked about is commentary that we empathize with, we relate to some extent. Travel transport, we are seeing pockets of spend coming up. They are centered around security. Spend is centered around digitization, they're centered around productization, and they're also centered around spend being directed towards customer experience-based projects. Having said that, there are initial signs of, I won't say stress, but of a normalization in spend going forward. We would expect our travel vertical going forward over the next 12 to 18 months to continue to grow in line with the broader firm's growth, but not to outpace it.
Sure. And one last one, if you could also talk about the board replacement post-ownership change that has happened at the company.
I'm sorry, I lost you, Manik. Could you please repeat that question?
Sure, Sudhir. So just wanted to understand your thoughts around the reinforcement of the board post-ownership change.
Yes, Manik, as I said at the outset, the leadership team, the board, the leadership team believes it's a privilege, it's a very serious responsibility for us to have emerged as the first professionally run board-governed organization. Today, during the board meeting, 2 of the directors from Baring Private Equity Asia have stepped down. We've called that out as part of our result pack as well. Going forward, we are working The board is working. The NRC of the board is working. All of us are working towards reconstituting the board. And we would expect that process to get consummated or largely be in shape over the next 1 to 2 years. And we will update you on the next quarterly meeting around that.
Sure. Thank you and all the best for the future.
Thank you, Mani.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask a question. Participants connected on the video link can click on the Q&A tab and click on the raise hand icon. Thank you. Our next question is from the line of Ravi Menon from Macquarie. Please go ahead.
Hi, thank you. So you've shown pretty broad-based growth across all verticals. Can you explain BFS, where I think most peers have struggled, but you actually shown pretty good growth?
That's right, Ravi. As we said, there are green shoots, even though the macros are stressed. Digital transformation spend has not necessarily gone away. The play around product innovation, the play around legacy modernization, the acceptance of challenger organizations like Coforge. At $1 billion, close to 55 to 60% of our revenue comes from financial services, has really picked up. So we are seeing growth from some of the areas that I talked about. We are seeing growth also because of our ability to penetrate increasingly at scale into tier 1 financial services organizations as a very credible challenger. And we also continue to see growth across BFS in areas like advanced analytics. John, would you like to add to that?
Sorry, I was on mute a bit. Yes, I would actually. There's a few things on this, and it's been feedback from some of our tier 1 banking clients. When we've been working with many of these kinds of clients, it's been very, very focused in very specific areas. We haven't spread ourselves across the whole enterprise. We've focused on very, very key business-aligned areas, and many of those are in the non-discretionary spend areas. So we're heavily involved in a number of tier 1s around payments processing. As you may be well aware, there's some major changes going on at the moment. There's also in the regulatory and the compliance space, 2 areas where we're heavily involved in the transformations going on at banks. So the combination of us being very, very focused and therefore very, very competent in key areas, along with it being within the non-discretionary and transformation areas, has meant we've been able to grow where others have struggled.
Thank you, Ravi.
One more follow-up from me. Your BPS business also has held up pretty well. I know that you only have probably a small exposure to mortgages. You spoke about it before, but can you speak about what are the areas that are growing well in your BPS business?
So in the BPS business, Ravi, one of the overriding premise behind doing the SLK acquisition 2 years back was because it was a banking-only focused BPS business, and our premise was that we would be able to extend that business more actively into insurance and travel verticals, which has happened. We were also convinced that we could take the BPS capabilities across the other financial services clients of Coforge, and that again has happened. Today, when we talked in the commentary section around new wins, we talked about 3 large deals, but equally importantly, we talked about a $10 million BPS deal. The fact that we've been able to get new leaders, both at the front end and at the back end over the last 2 years after the acquisition was consummated, the fact that the team has seen very significant investments come in, the fact that it is possibly an exceptionally stable, not just management team, but a business with possibly the lowest attrition across any BPO player, and the fact that our AI and analytics business have been able to work very closely with the BPO team to make a difference has really helped. John, any other comments on that?
Yes, one comment I'd like to make there is the fact that we've combined automation and technology with our BPS. We haven't just focused on people on seats. We've actually focused on how we deliver value to our customers, and that's resonated very, very well.
Thanks, John. Thanks, John.
Thank you.
Thank you. Our next question is from the line of Shraddha Agarwal. Please go ahead, ma'am. From Asian Market Securities.
Congrats, Sudhir, on a steady quarter. Two questions from my side. Can you highlight more on the 3 large deals that we've done? As in, what is the proportion of net new deal contribution, and any highlight on which sectors have you won these deals in? And the second question is to you, Saurabh. I mean, when you said that adjusted for hedge losses, EBITDA margin would have seen an expansion of 200 bits. But when I look at the hedge loss number in absolute term, it seems to be flat on a Q-on-Q basis. So how does the margin expansion of 200 bits come through then?
Thanks, Shraddha, for both the questions. Saurabh, would you like to take both questions, color around the 3 large deals and the hedge loss question? Saurabh, you're on mute. Sorry. No. Go ahead. Yeah, now you're good. We can hear you now. No, we can't hear you now. Can you unmute yourself?
Can you hear me now?
Yeah, we can. We can hear you.
Yeah. So 3 large deals came in. One was from the BFS space, which was a new account. And this was an account which we were kind of going after for the last 6 months. So it's within the BFS, in the BPS space, so within banking. So that is one. It's a new logo, 100% new revenue. Then the other 2 large deals came in, one from the travel vertical within the EMEA space, and one was a renewal.
Yeah, and as Saurabh said, one of the out of the 2 travel deals, one was with one of the leading Middle Eastern airlines, and the other one was with another, possibly the leading European airline. So that's where the 2 travel deals came from. And as Saurabh said again, Shraddha, what was interesting about the BFS win was this is a large deal. We've opened a new client in BFS last quarter, despite everything that's talked about around the uncertain macros, with a large deal. So it's not an incremental scope. Saurabh, would you like to address your or the hedge loss question as well?
So hedge losses in the current quarter were flat as compared to the previous quarter. Next quarter, going forward, these hedge losses will convert to hedge gains. So we will, assuming the currency remains at the current levels, we at least assume there will be a 50 bips fillip on the margins just because of hedge losses getting converted to hedge gains. So that's where we are today. So currently we are at almost 10 crores of hedge losses in quarter 2, which at current levels will get converted, if I just do mark to market, close to 3 odd crores of hedge gains. So there will be a fillip of 13 odd crores going forward as we move to Q3 and probably even more in Q4.
Got it. Yeah, got it. And the last bit from you, Sudhir, some of our larger peers have been indicating stress in their existing book of business because of discretionary projects being on hold by certain accounts. So do we see a similar situation for our discretionary book, or how do we see our existing book of business altogether?
Shraddha, I believe you're right. The macros are stressed, but we've also always maintained that for robust growth to happen as a firm and as a team, we shouldn't just be signing large deals. That's vitally important, but we should be focusing equally strongly on retaining the existing book of business. Otherwise, the good fancy stuff gets done, large deals are announced, and when you look back subsequent quarters, you don't find revenue going up, and that's largely because the quiet drift that keeps happening around delivery because of client dissatisfaction or a lack of client delight more than negates whatever good comes from signing large deals. So what has worked for us is the fact that our repeat business for a firm our size is possibly one of the highest, 93%. Just summarizing the answer, yes, everyone's right when they talk about the macros are stressed. But are we able to retain our business? I think the answer is yes, and that answer is also borne by the fact that not only have we been calling out over the last 4 quarters largely, but we've been backing that up with actual revenue growth and material growth subsequently.
Thank you, Sudhir, and all the best.
Thank you.
Thank you. Our next question is from the line of Rishi Jhunjhunwala from IIFL Institutional Equities. Please go ahead.
Yeah, thanks for the opportunity. A couple of questions. One, couple of levers that you've talked about in terms of margins over the medium term. One was, the initiatives around reduction in ARC, and second is, increasing the offshore mix towards closer to 55% versus 52 where we are today. So just wanted to understand on both these metrics how much, so of course, offshore mix we can see, but on the ARC, how much we have progressed, and by when do we expect how much expansion coming through that? And on the offshore side, any timelines in terms of by when do you expect to reach that 55% plus number?
Rishi, I'll give it a good shot and then I'll request Ajay also to chime in if he has other comments. 55% offshore is what we're heading towards, but I don't believe it's going to be a very rapid upward glide towards 55. So it's a little difficult to call out how many quarters it will take. So we do think that's where we are likely to ladder up and get to. As far as ARC is concerned, we are not happy with the progress that we made on ARC. Second half is when we expect to be very aggressive around ARC reduction. I called this out earlier also. We were possibly one of the few, if not the only, tech services firm that on the 1st of April gave 100% of the increments. We gave very high variable payouts as well. So when I look at ARC, are we at the midpoint of the year on ARC where we wanted to be at the beginning of the year? The answer is no. But are we equally committed that we will deliver on the ARC promise before the end of the year? The answer again is a very strong yes. So long story short, we are not happy with the cost down that has happened so far. We are now going to be heads down working on making sure that the ARC drops more significantly in the second half going forward. Ajay, would you like to add to that?
Sure, Sudhir. As you mentioned, Sudhir, we are working on the ARC and we are focused to drive it down. Though it has not happened till now. However, there are actions that we are taking, and we believe that by the end of the year, we will be at the targets that we had set out ourselves for. And that's another lever that we have for the margin improvements for the second half.
Understood. And second question is just on your, other vertical outside of BFS and transportation. So I guess you had in the past talked about splitting it up sometime in the near future, but just among the 2 or 3 key verticals within that, can you give some color in terms of how, the momentum is building there?
Yeah, retail, Rishi, seems to be doing well, much smaller base, but material growth that we've seen. Public sector has already scaled up. Don't hold me to the numbers, but it's almost about 7 to 8%, roughly about 7% of our aggregate revenues. And that business continues to be robust. We do expect it to go up. You're absolutely right about the fact that we have committed to carving out a new vertical and calling out those numbers. We will start doing that starting next year, because end of the year might be a logical time to start making changes to the reporting structure.
All right. Thank you. All the best.
Okay.
Thank you. Our next question is from the line of Saurabh Sandwani from Sahasrar Capital. Please go ahead.
Hi. So, despite the furloughs in Q3, you expect a margin expansion of 100 basis points. So I understand that partially it's due to the hedge gains expected. But what are the other levers?
So let me just be very clear. In Q3, we expect revenue growth to be tepid because all 4 of us out here are not standing and talking about the fact that we will not see significant furloughs. We will, like every other organization. Revenue growth will be tepid. Margin expansion will be significant, which was the point that Saurabh made, 100 bits, possibly higher, around 100 bits at least. One driven, as you rightly said, because of the hedge gains, the reversal on the hedge front that we talked about. Second, driven by what we just talked about, the ARC initiative that Ajay and I were talking about. We expect that going forward to be also a significant mix. Did I miss anything, Ajay, Saurabh?
Yeah. So I think that we also every year, either towards the end of September or beginning of October, do a client event. So that will again add almost 40 odd bits into the margins next quarter. So I think as we move from Q2 to Q3, one is hedge losses converted to hedge gains. Second is the impact of a client event which happened in Q2, which was an annual event, which will again give the margins next quarter. Third thing is ARC initiative has seen slow movement, but whatever actions have been taken, some benefit of that will start flowing in from Q3 onwards. So that benefit will start coming in. So I think those benefits will offset the impact of the furloughs, and hence we will see at least 100 bits plus margin improvement. So that's how we're looking at it.
Right. And sort of just to build on what your namesake Saurabh talked about, what we normally did was our annual client event used to happen in Q3 of a year. As Saurabh said, we did that in Q2, and that's the pro forma size, that's the material spend. We would like to invite some of you to attend it. We would like to think we throw a very good event. Because that event happened in Q2 and the costs have been fully booked by Ajay, Saurabh and their team, that is not going to be a cost impact in Q3, and hence the 40 bits of time that we saw.
Okay. Thank you.
Thanks, Saurabh.
Thank you. Our next question is from the line of Abhishek Kumar from JM Financial. Please go ahead, sir.
Yeah, hi. Thanks. Good morning. Sudhir, my question is on deal wins. BFS, from what we hear from most of the players is that most of the deals out in the market are kind of vendor consolidation, cost takeout deals. At the same time, we continue to win new logos in the BFS space. So I just want to understand, who are we winning against? Are we kind of consolidating local subcontractors, or are we winning against some of the larger peers in this space?
So both I could see John smiling. Both John and I will attempt an answer. Abhishek, in the real world, right? Other than analyst reports, mid-tiers don't compete with mid-tiers. So firms our size, if I look at 19 out of our top 20 clients, our biggest competitor there is a scale IT player. Could be anyone from Accenture to Deloitte to the TCSs of the world. These wins are coming against those players. They always have, and I suspect they always will. You will very rarely, if at all, have a mid-tier competing with a mid-tier at scale in an enterprise IT client. So that's the ground reality. John, would you like to add to that beyond the smile?
Not too much, but yeah, I mean, we are winning against the tier ones significantly, and I think it's down to the fact that we're able to execute so well. We've got a recent case in Australia where we won against a tier one, which is part of the business, and because of the ability to actually execute so well, we're actually taking more and more business. That's just a classic example of what we're achieving.
Okay. Second question is maybe on the smaller deals. A significant part of our deal wins still constitute of smaller deals. Just wanted some color on the kind of deals which we are winning here. These are largely renewal, or we are also getting net new deals. And any change in the type of deals here and the pipeline that we have in the smaller deal space.
So Abhishek, to the point that John made earlier, the smaller deals are won on the back of execution. No client asks a vendor that is delivering well ever to leave. That's an axiom in our industry. That's where most of the growth comes from. The headlines come from large deals. The growth comes from delivery. So the reason why we're signing large and small deals, and I think it would be very unfair to start characterizing them into 3 or 4 buckets. These deals are contextual, depending on the client, depending on where they are on their tech journey, depending on where they are on the budget spends. They are of all kinds. I know it's fashionable these days to try to bucket them into cost consolidation or something else. They include cost consolidation deals. They include a lot of productization deals. They still include innovation deals. And to your question around NN, as I said, one of 3 large deals that we signed during the quarter was signing a new client with a $20+ million contract straight off the bat. John, would you like to add more color to that?
Not too much there. I mean, I'll keep coming back, and you mentioned it, execution, and quality. And what we're finding is a lot of the CXOs that we're dealing with are actually turning around and saying, you're different because of the quality of your execution. And what is helping us is, as we're seeing in the public sector at the moment, certainly in the UK, is where those CXOs, they tend to then move around every few years into other parts of the public sector. And they're actually reaching out to us as soon as they get into those new organizations to say, how can we get you into our organization? And that's helping us develop. But it's all on the back of execution.
Great, that's helpful. One maybe last clarification. Sudhir, you mentioned you expect Q3 to be tepid. Then, in that case, that would really increase the ask rate for Q4 significantly. So in that context, just wanted to understand, are we seeing that kind of pickup, as we stand today? Or maybe in other words, are we still confident of achieving, even the upper half of the guided band?
Difficult to say, Abhishek. What we are absolutely crystal clear on is that the guidance that we gave at the beginning of the year, which was very aggressive guidance, 13 to 16% growth, is the guidance we will deliver on. Q3 is going to be soft. I think it will be soft for the industry. It furthers this year have been very aggressive. We believe, and we've always said this, we believe that we always have a very strong fix, given the execution that John talked about, on 2 quarters here on. So we, at least internally, know the broad number we will land at in Q3, which anyway, almost 1 month out of 3 is gone. Even Q4, we have a clear fix. Q4 should see a material upside compared to Q3. Tepid, of course, is a qualitative term, so our intent is to make sure that it's not terribly tepid, but we'll try to be on the higher end of tepid in quarter 3 for now. That's how I would put it for now.
Sure, that's helpful. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Rahul Jain from Dolat Capital. Please go ahead, sir.
Hi. Thanks for the opportunity. Just one question. That since, of course, you mentioned some of the things that will benefit the profitability near term and for this year, but as a measure to protect margin or do cost optimization, is there an active program, given that there is a potential risk of growth slowdown at some point? Or you are saying that since the momentum for you is continuing, you don't looking more on the cost optimization, but more on the growth side of the business?
Well, we always look at cost optimization, but we do not do cost optimization on the back of cost outs that impact our employees. We believe that is counterproductive, and those kind of optimizations are attempted by firms that are not confident of growth. We are crystal clear. We are a growth firm. We will deliver growth, not just in FY24, where the guidance is 13 to 16%, but in FY25, 26, 27, and thereon. So cost optimization, are we focused on? The answer is a definite yes. But please also remember, we're possibly the only IT services firm that on the 1st of April this year gave 100% increments, gave exceptionally high variable payouts for the previous year, and we will continue to follow that path. The cost optimization, will we do it? The answer is yes. Will we do it at the expense of things that in the long term will help the growth trajectory of the firm? The answer is no.
Sure, that's very encouraging. Thanks.
Thank you. Yeah.
Thank you. Our next question is from the line of Vibhor Singhal from Nuvama Equities. Please go ahead.
Hi. Thanks for taking my question. I'm sorry I joined the call late, so I hope the question has been answered before. So Sudhir, my just one question is on the margin guidance. I think for long we have kind of guided margins on the adjusted basis. But at the end of the day, the ESOP cost that we give, I think the ESOP cost that we adjust the margins for is a part of the business and it's part of the compensation that we give to the employees. So any roadmap or any outlook as to when we could actually look at providing a margin guidance on a reported basis? Because I mean the gap between the two, is quite big even for this quarter, for multiple quarters, and eventually that cost does translate people down to the profit numbers and eventually the profitability of the company. So any color on as to when we could probably maybe move to more of a reported basis margin guidance, which could help probably help get a better understanding of the profitability of the company.
That's a fair question, Vibhor. Ajay had pointed out earlier in the call that this year there's been a spike in quarter 2. We expect the cost to normalize quarter 3 onwards. In next year, as Ajay said, we expect the ESOP cost to come down. Ajay, correct me if I'm wrong, by about 30-40 bits from wherever we're likely to land up in fiscal year 24. We've taken note of your suggestion and we will work on that and then revert to you in the future around giving reported EBITDA guidance.
That's very interesting. Thanks a lot. Thanks, Sudhir. That's it from my side. I think most of the questions are very amazing answers. Wish you all the best.
Thank you, Vibhor. Thanks a lot.
Thank you. Our next question is from the line of Ashish Das from Mirae Asset Capital Market. Please go ahead.
Hi, good morning, and thanks for the opportunity. So, Sudhir, I just want to understand. Usually, we say that Q2 used to be a strong quarter in terms of revenue growth for a year. Now, this quarter, we have the growth is moderated compared to Q1, and so just wanted to understand your view why this it happened this time that Q2 growth is not so strong.
Well, I mean, Q2 growth. 2.3% has still meant that at the end of the first half, we're growing 16.2% over the first half last year in CC terms, Ashish. That 2.3% growth comes after a 2.7%, a 3.7%, and a 4.7% growth. So if you look at the last 4 quarters, sequential growth has been between 2.3 to 4.7. If you were to ask me why has there been a slight deceleration, the answer is the same that we've heard in the call repeatedly. The macros are tough. And that's why we are at the number that we are right now. At the same time, as we also said, and I think it's important to reiterate, what we said at the beginning of the year, the guidance we gave, we will deliver on. That we continue to maintain. We have maintained, and we will continue to maintain. Even at the end of Q3, you will not hear me, Ajay, John, Saurabh say something different. We will deliver on the guidance given at the beginning of the year, which was an aggressive guidance. That's how I would respond to that question.
Okay. And my second question is, I can see that top accounts, actually top 5, top 10, got declined quarter-on-quarter basis. Anything to read there?
No, Ashish, I won't read much there because last quarter, the top 5 accounts, if I remember right, went up 12.5% sequentially. Sort of keep me honest on this, but it was about 12.5%. That was a massive spike. This has normalized. Top accounts, relationships are solid. Growth on a secular long-term basis will continue to be solid.
Okay, good. Thank you.
Thank you.
Thank you. Our next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yes, sir. Just a clarification. Saurabh, you mentioned and quantify about the hedge gains in the Q3 and Q4. Sorry, I missed it. If you can repeat the same, it would be helpful.
Okay. So I mentioned that in current quarter, we had a hedge loss of 10.5 odd crores, which at the if the currency stays at the current levels, don't move much, we should be seeing a hedge gain of 3 crores in the next quarter, and it will only expand in Q4. So that's what I said.
Okay. So that may drive 50-60 bits kind of a Q1 tailwind.
Easily.
Okay.
50 odd bits, assuming the currency stays at the current levels, it should be a 50 bits.
Okay. So Sudhir, in that scenario, that plus no client event which will have a tailwind of 30-40 bits, margin uplift could be higher than 100 bits in the Q3 itself, right?
Well, I hope you're right. That's the intent. It's a valid question, Sandeep. That's going to be our intent. But as Saurabh said as well, right? A lot of it will also play into currency movements as well. Hence, we've said broadly about 100 bits. We will attempt to try to make it beyond 100 bits sequentially.
And Sandeep, what will happen is we all know there'll be furloughs in the next quarter. So benefit of this, a part might get set off against the furlough impact, but three levers. One, the losses getting converted to hedge gains. Second is the client event and a bit of actions that were taken in Q2 around ARC. Some benefit will start flowing in. That will get set off against the furlough impact that's coming in. But net, we're still looking at 100 bits at least, and then looking at beyond that. So that's how I will table the overall waterfall.
Thanks, Ajay, you were trying to say something. Would you like to add to that?
And Sudhir, I was just trying to mention the point about the furloughs because that's going to offset the gains that we are going to have. So, yeah.
And Ajay sir, is it fair to assume ESOP cost may decline by 30-40 bits by FY25?
Yeah, they will decline if no further ESOPs are given on the current level. They will decline at around 30 odd bits next year.
There's a high probability, as Ajay said, Sandeep, that it will decline by about 30 bits.
Okay, thanks, and all the best.
Okay.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I now hand the conference over to Mr. Sudhir Singh, CEO, Coforge Ltd, for closing comments.
Ladies, gentlemen, thank you very much for your time. It's early morning in India and late evening in the States. Thank you very much for your time, for your interest, for the commentary, and for the insights that you leave us with. I just wanted to point out that over the last few quarters, we've also started doing this, the investor call over video. We're not much to look at, but if you do want to join the video link going forward, we would really appreciate seeing you as we answer your questions. We will make sure that the video transcript is also uploaded immediately after this conversation on our website. Thank you once again, and we look forward to seeing you next quarter. Bye-bye.
Thank you. On behalf of Coforge Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.